Ron's final question. What is your recommended management on credit spreads, profit and loss? Preferred criteria is the weekly bull puts looking 8 to 17 days out in time, 2-week expiration with a minimum 9% return on the position. Target range is a return of 15.8, 15.9% return on the positions, while keeping the loss to 50% of the maximum loss you could lose on the spread position. MicroStrategy is right in that wheelhouse right there. This is not a recommendation because if you tried to trade this on Monday, the numbers would be different and the stock will be different as well. Entering into a position where Microsoft's at 216.97. Sell to open the 162.5 for 288. The 160 put to buy at 254. Net credit of 34 cents against a true risk of 216. The most I can lose on the position in that case, even if the stock's trading below both strike prices. So keep the 34 cents regardless of what happens. So I might pay 250 to close it, kept the 34 cents, only losing 216. Max profit is 15.7%. This was based on using a probability of 85% or higher. Oh, don't like that pen color on the white background, do we? Sorry about that, Ron. All right, here we go, guys. 85% probability or higher in the search function. And as you saw earlier, I mentioned stocks trading above the SMA 20. In addition to that, that positive MACD crossover at least 3 days ago. So it's been at least in a positive MACD crossover for 3 days or more. No earnings between now and expiration, positive earnings per share growth of 5 to 7%. You can see those on that weekly bull put screen. Now, what am I going to do as far as management on these positions and targets for profit and loss? Well, this is my target. That's what I want to see. I do not close at 50% early for a credit spread, out of the money credit spread. That's more for an at the money debit spread. I don't close if I get a 7% or 7.2% profit. I'm holding as close as possible to the full 15.7%. I will look to close the position if the stock hits the 50% loss. In other words, when I move to liquidate this position, tracking it in the portfolio, if my liquidation loss is 103 on this trade, I'm going to look to close the position to keep the loss to only 50% of the maximum. Why? Because if I allow it to go to the full loss, I've wiped out 8 previous trades. If I close it here, I've only wiped out 3 or 4 previous trades with a similar structure. That's manageable. 8 trades is not. 9 trades at a time is not with that win-loss ratio. You can't let them go to 100%. How do we keep the loss to 50%? Well, I'm going to look for certain triggers. The stock reaches within the 1% rule, starts to fall from where it is right now towards my short put strike price or short call strike price moves up, and I reach within 1% of the sold put, I'm going to consider 8 ways to manage the bull put credit spread, or 8 ways to manage a bear call credit spread, Ron. If I'm in the trade and the stock is nearing the 1% rule, and my stock is now trading below the SMA 20, and instead of having a positive MACD, I now have a negative MACD crossover, 2 of the 3 signals that I've used, I'm likely going to close the position, especially if it's near that 50% loss on the trade. If I'm at the 50% loss, the stock's below the SMA 20, and I see a negative MACD crossover for a sudden move, I'm bailing out at that point before that comes a 60, 70, 80% loss with some kind of adverse market condition clearly going on in those cases. What are the ways to manage the spread? Well, as we kind of talked about with the long call before, I could just close the position, accept the loss, and move on. That's usually the common way that I do it to keep my win-loss ratio in place for my personal targets and what I'm looking to achieve. They're not going to be yours. They don't have to be yours. It's what I'm looking for going forward. You could do nothing and wait to see if the stock recovers. Number 2. Number 3, I might be able to just buy to close the short leg as the stock is falling a short put in this case, and if it continues down, maybe that long option will counter the gain that I've taken in that position. I can move just simply the spread down in price, not something I commonly do. That's a way to get in more trouble. You keep rolling down and adding to the risk and getting a lower positive return. The stock keeps falling. Just like averaging down the stock, you're increasing the monetary loss on the position, and you're still taking 40, 50, 60% of a loss each time you close and roll down to a new position. But it's an option that can work depending on your outlook. You could convert it to an iron condor, for example, by selling the opposite legs. If the stock's falling here and I do that, what does it do? It raises my roof here of possible potential return, but I could still lose to the downside. It doesn't erase this downside loss. I could still have reasonable losses to the downside. It doesn't address that. That's why I don't commonly use the condor or butterfly fix when it starts to move against you, because it didn't address what was potentially at risk. And it gave myself two ways to have potential risk on the position. But it is an option that's commonly used. Sometimes I'll use what's called the pendulum adjustment. The stock is reaching near my short put strike price 1% rule. I'm in a bull put credit spread. I may close the bull put credit spread and do the opposite. That's an option of the 8. Or I could simply swing my 160 put out to the 170. Sell to close my 160, buy the 170, and in one movement, I could convert my bull put credit spread to a bear put debit spread, whereas the stock continues to move down in price. I might be at a profit, smaller profit than what was expected initially because of the adjustment, but with one movement, instead of changing over entirely from a bull put to a bear call, the pendulum adjustment, swinging the 160 out over the pivot of the 162.5. I'm sorry, it'll probably be the 165. That's an option. Do I expect you to understand everything I just said and absorb it all in and say, okay, I'm ready to go now and start managing the positions, Ron? No. I just use that as a review very quickly. And the reason why, again, is we go back to power options. Let's go into playlists. And let's go to bull put credit spread, view full playlist. So I'm going through, there's the tools for credit spreads, 2 ways to trade a strategy. Bull call debit or bull put credit, parity trades of one another when you're comparing the same strikes. Clarifying suggested stops. Bull put spreads, closing outcomes and setting alerts. 8 ways to manage a bull put credit spread. The pendulum adjustment for bull put credit spreads that was done an actual trade in February when the market looked like it was starting to come off of those January 2020 lows. In mid-February, I entered 3 or 4 new bull puts, went back into it, didn't trade them at all during January, Ron. We went back into them here, and 1 or 2 of them went against me, and I was able to use the pendulum adjustment successfully on 2 or 3 of those to convert them to a bear put debit spread to have a profit, where I would have taken more of a loss on a bull call. Let's go back and talk about other spreads, bear calls, view full playlist. Repairing a bear call spread, 7 ways to manage a bear call, tools for the credit spreads, setting up bear call credits, criteria, and more. So there's also what trades are used in a bearish market, other content related to that. One's also on, bull call debit spreads, calendar spreads, calendar call, diagonal, poor man's covered call, 7 to 8 videos on those, including criteria, management, and much, much more. So the full discussions of our approach for analyzing what we like to use with these structures, you can find in those playlists. You could also do the search on power options for bull put credit spreads, bull put criteria, bear call criteria, calendar spread criteria, and you see a list of different videos run for that. That's why I skipped over that last part so quickly, even though there's a lot of information. Even in the bull call debit spreads, you'll see 7 ways to manage a bull call debit spread. And you'll see the 8 ways to manage a bull put credit spread and the ways to manage a bear call credit spread as well in those playlists for more in-depth look, analysis, and beyond that we just showed as a basic review in these last few moments of the webinar.